Many lenders allow a family member to help you to buy your own home by providing additional security. The person providing this assistance is known as a guarantor. This is different to being a co-applicant or a co-signer. A co-applicant is included on the loan and will be responsible for the entire loan until it's repaid in full. A guarantor, on the other hand, is linked to a loan by a guarantee. This guarantee can be released and the guarantor's responsibility stopped without the loan being repaid in full. To use a guarantor, you must be able to service the entire loan on your own income. A guarantor allows the equity in their own property to be used as additional security for your loan. The primary security for the loan will be your property, but the lender will also take out a mortgage over the guarantor's property. This mortgage will not support the loan directly, but will be used to support the guarantee from your guarantor. Guarantors are generally limited to immediate family members. Normally, this would be a parent, but guarantors can include siblings and grandparents. Some lenders will allow extended family members to be a guarantor to a loan, but this varies depending on the lender. If you're unable to pay back the loan according to the terms of your contract, the lender can take legal action against you and, in some circumstances, your guarantor. Your guarantor will be liable for the amount specified in the guarantee. Anyone who is considering being a guarantor for a property loan should seek independent legal and financial advice before accepting the role. Most lenders will insist on this also prior to accepting a guarantee. It's important to note that a guarantor's ability to borrow will be reduced after they agree to act as a guarantor. If you don't have enough deposit, but you do have the ability to make the required home loan repayments, a guarantor could help you to secure additional funds to buy a home. Saving a deposit can be daunting and very hard to do when you're also paying rent. By having a guarantor, you may be able to borrow the full purchase price and sometimes even the costs associated with purchasing property. This varies across lenders. Some will insist that you contribute some of your own equity towards the purchase, even if you have a guarantor. Another benefit of having a guarantor is that you may save thousands of dollars by avoiding lender's mortgage insurance. Generally, lender's mortgage insurance is required for home loans where you have less than 20% deposit, meaning the loan is greater than 80% of the value of the property. Lender's mortgage insurance is a type of insurance which lenders take out to cover the additional risk of high loan-to-value ratio lending. Although this insurance covers the lender against the risk of you defaulting on your loan, you get stuck paying the premium. The amount of the guarantee depends on the individual lender's policies. The guarantee can vary from the full loan amount to as little as 20% of the loan, where the loan is 100% of the purchase price. After you've built up equity in your property, your guarantor can ask to be released from the loan. The time frame to achieve this varies depending on the original deposit, the number of extra repayments made, and whether your property has appreciated in value over the time period. Depending on the lender, you may be required to pay some additional fees to release your guarantor. This can include a fee for the lender to revalue the primary security property as well as lender discharge fees. If you have any other questions regarding guarantor loans, feel free to send us an email or call us on 9421 1651. Thanks a lot.